Hey, I'm Alan Sublank. In this video, I'm going to talk about the two things that day traders need to feed off of to be profitable. So I can grab my whiteboard and tell you what those two things are. They are liquidity and volatility. Liquidity refers to volume, how many shares of a stock are traded, liquidity, and the volatility. So day traders should look for liquidity and volatility. Volatility means that the stock will go up a lot or down a lot, so it'll increase in value in a short amount of time or decrease in value in a short amount of time. So you need both of those things in setups to be a profitable trader. Now on the chart, if you remember in previous videos, when I draw a candlestick chart, you'll see on this axis you'll have some prices like $1, 110, and 120. And then if you recall down here, this shows the times, but then on a candlestick chart, there's also underneath the times, the time frames will be volume usually, depending on the software you use. So I use Thinkorswim by TD Ameritrade. You can, I think it's free to open an account. You don't need to fund it with any money, but they might have changed that now. But I use their software, Thinkorswim, to look at charts, and then I also have it on my phone. And so on candlestick charts down here, there's usually the volume, and the volume is what is referred to as liquidity. And usually it'll be shown in bars. You'll see how much volume, and during different times the amount of volume may decrease and increase. And then the volume can be shown maybe in the thousands or in millions. So maybe up here, this would be 800K. So that means 800,000. So let's say if the stock market opened and there was a green candle, underneath this candle is the volume. And so let's say the stock market opened at $1 and it started to go to about $1.05. You can see that 800,000 or 800K volume traded during this time. And if you're looking at the 1 minute chart, this means that in 1 minute, 800K volume was traded. So that could mean people collectively, the retail traders, they could have bought altogether 800K shares in this stock, or it could mean it's a mix of buying and selling, and there's other options that you can do, but just for the sake of this video, I'll just talk about trading as being buying and selling. Okay, but there's other stock orders you can take. And normally when the market opens, the volume will be a lot higher because most people, they can't trade pre-market. And pre-market, on a candlestick chart, there might be a line maybe dividing the pre-market session, and pre-market during New York time opens normally around 7 a.m. Sometimes it can be as early as 1 a.m. So I'll just write 4 a.m. New York time. So from 4 a.m. and I'll say to 7 a.m. This time frame represents like the early pre-market activity, and then from 7 a.m. to 9:30, so I'll just write here, or when the market opens here, it'll be 9:30. So the volume normally during pre-market time, so I'll write pre-market here. Pre-market, before the market opens, the volume usually will be a lot less than when the market is open. So maybe here the highest volume gets to like 50,000, and most of the volume is 10,000 or under 10,000 shares. So pre-market, it's not the best time to trade because the stock will say it's not as liquid, or there is less volume. So this means if there's big traders and they want to capture on the move, they will normally wait till market opens, because when you take a trade, you don't want to make up more than 10% of the volume during the candle time frame. So if this is a minute chart and someone has a big account, they shouldn't, if this stock traded 800K volume right at market open, they shouldn't buy 250 shares in this stock, because that would make up more than 10% of this volume. But if they wanted to buy 10,000 shares at a dollar, when market opens, their order will be more likely to get executed because that is this stock is liquid. There's a lot of volume, so they could get in and out easily. They can buy and sell easily. The volume will be there. And so you have to think when you buy, there's also needs to be some sellers too to buy the shares that you're selling into the market. And so you'll want to be paying attention to the volume to make sure it's liquid. So let's say if you wanted to buy 10,000 shares during pre-market, and if we said we don't want to be more than 10% of the volume, and let's say if the stock pre-market was around $1 but since the volume is very low here, it's not ideal to buy pre-market because it's not that liquid. So when you have liquid stocks like this gives day traders opportunities to take up size. The ones that are making a living day trading, their normal position sizes might be 10,000 to 30,000 shares, especially on a dollar stock. And they need that volume. So if this were, on the other hand, if this were instead of 800K volume here at market open, if this was only 80K volume, and then these candles here would be under 80K, so the guy who wants to buy 10,000 shares, this isn't really as liquid. It's not really considered a liquid stock for a dollar stock on that's trading if it's only 80K volume. Okay, but let's say this is 800K, so this is a good liquid stock, and normally when the market opens, the volume can be high and the stock might start to spike. Maybe it goes up to 110 here. And normally that first hour is going to have a lot of volume because most day traders, if they use stock brokers like TD Ameritrade, they can't trade pre-market, so they'll put in a buy order when market opens, and then when market opens, all the Robinhood traders, their buy orders will get executed. So for that reason, people who use brokers like that will cause there to be an unusually high volume during market open. So let's say it goes up, spikes to 110, and then there might be a little bit of consolidation here around 105. And so during the time when there's consolidation, during this time, we'll say the stock isn't as volatile, but during market open and when the stock is increasing fairly quickly, like this stock would have moved 10% in just 2 minutes, so that's pretty volatile. And then considering the volume, this gives traders, day traders, an opportunity here. They could have bought around $1 and then sold into the spike for a quick 10% gain, and they could have sized in. And if they bought 10,000 shares and they made 10%, would have made $1,000, fairly quickly right at market open. But again, if this was not liquid, if this was only 80K volume, those day traders wouldn't be very easily able to buy 10,000 shares and get in and out and make a quick 10%. So normally during times where the stock is less volatile, the volume will be less. But then let's say if the stock starts to get volatile again, maybe it goes back to $1 and it makes a quick move, the volume can increase. And then maybe there could be like a little breakdown, and then the stock kind of goes up and then goes back down fairly quickly. So since this is a volatile candle, let's say move to 10% or more in a minute, the volume will likely be higher because more traders will be buying and selling during times of volatility. Okay, so you should understand the two things that day traders look for in a stock now. Liquidity and volatility. You should always look for those two things when you're considering a setup.